All right, so if you're active duty and you've got a side hustle, you probably feel pretty safe, right? You know federal law protects your military pay from the state you're stationed in. But what about the cash from that second job? Well, that's where a huge, and I mean huge, financial risk is hiding. We're going to call it the civilian pay trap, and it's a real doozy.
So here's how we're going to break this all down. First, we'll define the trap. Then we'll get into the weeds on protected versus exposed income. We'll also cover the spousal protection gap, which is wild, how states can clash, the whole remote work mess, and finally, how you can actually navigate all this. Let's get to it.
Okay, Section 1. Let's really dig into what this trap is all about. So, I want you to ask yourself a serious question. Are you absolutely positive your moonlighting income isn't getting taxed by 2 different states? Because for a lot of service members out there, the answer is no. And that no is costing them a ton of money.
And that's exactly what the civilian pay trap is. It's this legislative black hole, really. Federal law builds a wall around your military pay, but it leaves your civilian income totally out in the open. So you've got your home state saying, you're our resident, we tax everything. And your duty station state saying, you earned it here, so we tax it. And your civilian paycheck is caught right in the middle.
So how on earth did we get here? Let's jump into Section 2 and look at the actual laws that create these 2 totally separate worlds for your money.
Okay, this is where we get into the nitty-gritty. It's like a tale of 2 incomes. On one side, you have your protected military pay. This is shielded by a very specific law, 50 USC Section 4001B. Think of this as your ironclad defense. It basically says to your PDS state, hands off. But then, look at the other side, your exposed civilian pay. Federal law? It says nothing, crickets. And that silence is basically a green light for your PDS state to tax you on that income because you earned it there. And at the same time, your state of legal residence, your SLR, is also coming for its cut.
And what's crazy is watching how this gap just got wider and wider over the years. Back in 2003, the SCRA locked down protection for military pay. Cool. Then, in 2009, MSRRA came along and protected the spouse's civilian income. See where this is going? Fast forward to 2018 and 2022, and spouses get even more power and flexibility. But what about the service member's civilian pay? Nothing. It was just left behind. Every single legislative update expanded spousal protections, but yours? It's been stuck in 2003.
All right, this leads us to one of the most, frankly, bizarre parts of this whole situation, the massive gap in how you and your spouse are treated under the law.
Get ready for this, because it's a jaw-dropper. Let's say you're a service member. Your legal residence is Texas, 0 state income tax. You get stationed in California and pick up a side job. Bam! You're paying California's 9% tax on that income. Now your spouse, who is also a Texas resident, moves to California with you and gets the exact same civilian job. I'm talking same desk, same boss. But thanks to 50 USC Section 4001C, their pay is totally exempt from California tax. They pay 0. You pay 9%. Same job, same state, same family. It's just unbelievable.
You can see how this creates some really weird incentives, right? For a military family, it's actually smarter financially for the spouse to get the second job, not the service member. It's a total economic distortion. The whole point of the law, MSRRA, was to help spouses, but in a strange twist, it ended up giving them better income protection than the actual service member. It's a classic case of unintended consequences.
Okay, so let's get into the mechanics of how this trap actually snaps shut. This is all about how different state tax laws collide with each other.
It really comes down to what we call the double assertion. It's like 2 states grabbing at the same dollar bill. Your PDS state says, you earned it on my soil, it's mine. That's source taxation. Meanwhile, your SLR says, hey, you're my resident, so I get a piece of everything you earn anywhere in the world. That's residence taxation. And boom, they both have a legal claim on your civilian pay.
And you better believe some states are way more aggressive than others. New York is a perfect example. Let's say your military pay is 50 grand, which is exempt, and you make another 10 grand from a civilian job. New York does something kind of sneaky. They look at your total income, $60,000, to figure out your tax rate. This pushes you into a higher tax bracket. Then they take that higher rate and apply it to just the 10 grand of civilian pay. It's a clever way to squeeze as much tax out of your side hustle as they possibly can.
Okay, this table lays it all out pretty clearly. Look at the first line. You're from Texas, with no income tax, but you're stationed in California? Well, guess what?
Your no tax benefit is gone for that civilian job. You're paying California's roughly 9%. Now, middle line. You're from Virginia, stationed in Florida. That's pretty much business as usual. You just pay your home state of Virginia. But look at that last one. This is the real pain point. You're a California resident stationed in Virginia. You pay Virginia's tax first, but then you have to turn around and pay California the difference between their rate and Virginia's. So in the end, you're still paying the full, higher California tax rate. Ouch.
So just when you thought it couldn't get any more complicated, along comes remote work, and it just throws a bunch of new landmines all over the place.
You've got to watch out for this one. It's called the convenience of the employer trap, and it is just as nasty as it sounds. A few states, like New York, have this rule. So let's say you're stationed in Virginia, but you're working remotely for a company based in New York. New York says, well, you're only working from home for your convenience, not ours, so you owe us taxes. But at the same time, Virginia says, you're physically here doing the work, so you owe us taxes. And here's the kicker. Virginia might not give you any credit for the taxes you paid to New York. That's not just a high tax bill, that's true double taxation. Same dollar, taxed fully, twice. And hey, for all you gig workers out there, driving for Uber, delivering for DoorDash, there's another trap waiting for you. It's called business nexus. Normally, under 50 USC Chapter 4001D, the SCRA protects your personal property, like your car, from local taxes. But the second you start using that car for a trade or business, that protection can vanish. Suddenly, your PDS state can slap you with personal property taxes on that vehicle. It's a whole other layer of liability you have to worry about.
Okay, so that's the mess. It's complicated, it's messy, and it can be really expensive. So let's shift gears and talk about what you can actually do to protect yourself. So your best new weapon in this fight is something called the VAEIA, which came about in 2022. The specific law is 50 USC Section 4001A3, and it gives you and your spouse a ton of flexibility. You can now jointly elect for any given tax year to be treated as a resident of one of three places: the service member's home state, the spouse's home state, or your current PDS.
But you have to be so careful here. This is a powerful tool, but it's not a magic wand. Here's how you use it smartly. Let's say your legal residence is in high-tax New York, but you're stationed in no-tax Florida. You can elect to be a Florida resident for tax purposes. You cut the cord with New York, and just like that, your state tax problems go away. But here's the danger. Flip it around. You're from no-tax Florida, stationed in high-tax California. If you elect California residency, you just made a massive, costly mistake. You're now a full-blown California resident, and guess what? Now your military pay, the stuff that was always protected, is suddenly taxable by California.
All right, let's wrap this up with the key takeaways. This is what you absolutely need to remember. Number one, know what's protected. That's your military pay and your spouse's civilian pay. That's it. Number two, know what's exposed. That's your civilian pay and your business assets. Number three, watch out for high-risk PDS states like New York and California. And number four, be just as careful if your legal residence is in a state like California or Virginia, because they can create some serious financial headaches.
So I'll just leave you with this final thought. Think of your military pay as living inside a fortress, completely protected by federal law. The question you have to ask yourself is this: is your side hustle building a huge tax disaster for you right outside the castle gates?